Hey everyone, welcome back to Corporate Decoder, the place where we try to find the shocking financial secrets companies try to hide in plain sight. And today we're diving into Illinois Tool Works Inc., or ITW's latest quarterly report. Get ready. Because this isn't just a bunch of numbers, it is a story about how a manufacturing giant is navigating through changing times and what that means for their bottom line. Before we jump into the nitty-gritty, you know the drill. If you love getting these kinds of deep dives into financial reports without all the jargon, you've come to the right place. Make sure you are subscribed and ring that notification bell. Also, we've got a fantastic community over on our Discord server, linked in the description below, where we break down these documents and more. Alright, let's get into it. This report covers the period ending the 30th of September 2025. Now, ITW is a massive global manufacturer with a huge variety of industrial products. They've got their businesses organized into 7 main segments, which is a key to understanding their performance. Jumping straight into the financial statements, we see the core numbers. For the 3 months ending the 30th of September 2025, their operating revenue was about $4.1 billion, a slight bump up from the previous year's $3.9 billion. But when we look at the 9-month picture, it is almost flat at around $11.9 billion for both 2025 and 2024. This tells us that while they are making a bit more in the current quarter, the year as a whole shows a very steady, almost static revenue picture. Now, let's talk about profit. Operating income for the third quarter of 2025 jumped up by 5.7%, hitting $1.1 billion. This is great news because it means they are not just making more money from sales, but they are keeping more of it as profit. This increase is largely thanks to their enterprise initiatives, which sounds like a fancy way of saying they're getting better at running their businesses. However, over the 9-month period, operating income actually decreased by 3.2%, falling to $3.1 billion. This decline is a red flag, especially when you consider that a big part of the 2024 numbers was a one-time boost from changing their inventory counting method. Without that boost, the profit picture for the year so far isn't as rosy. The operating margin, which is how much profit they make on each dollar of sales, tells us a lot. For the third quarter, it was 27.4%, up from 26.5% last year. This improvement is solid and shows they are managing costs well. But remember, when we said their year-to-date profit was down? Well, the operating margin for the 9 months reflects that, dropping from 27.0% to 26.2%. Again, even though they're better at making money per dollar in this quarter, over the longer haul of the year, their profitability on sales is a little lower than last year. Now let's look at the company's financial health on the balance sheet as of the 30th of September 2025. Their total assets are around $16.1 billion, up from $15.1 billion at the end of the previous year. This growth in assets is generally a good sign that the company is expanding or investing in its operations. A big chunk of those assets, over $5 billion, is in goodwill. Goodwill usually represents the premium a company pays when it buys another one, hoping for future profits. For ITW, this is a huge number, meaning a lot of their value is tied up in past acquisitions. On the other side of the balance sheet, we see $7.7 billion in long-term debt. This number has gone up quite a bit since the end of 2024, where it was around $6.3 billion. This increase in borrowing needs to be watched. More debt means more interest payments, which can eat into profits, especially if interest rates go up. Another interesting figure is the negative $26.5 billion in common stock held in treasury. This means ITW has bought back a massive amount of its own stock, while share buybacks can be good for shareholders by boosting earnings. Per S-Hair, it also means a large amount of the company's cash has been used for this purpose rather than other investments. Looking at the cash flow statement for the 9 months ending the 30th of September 2025, ITW generated about $2.16 billion from its normal operations. This is almost identical to the $2.16 billion they generated in the same period last year. This indicates their core business is a consistent cash generator, which is a sign of stability. However, when we look at where that cash went, we see they paid out $1.3 billion in dividends and spent another $1.1 billion on buying back their own stock. This is a huge amount of money going back to shareholders. While pleasing investors is important, it also significantly reduces the cash available for other things like acquiring new businesses or investing heavily in research and development. A notable item here is the $395 million received in 2024 from selling their stake in Wilsonart International Holdings LLC. This was a one-time cash inflow that helped boost the previous year's numbers. This sale of their stake in Wilsonart is a good example of ITW managing its portfolio. They divested a significant interest, which brought in a substantial amount of cash and a hefty gain. As mentioned in the notes, It shows a strategic move to streamline operations or capitalize on an investment. Now, let's break down how each segment is performing. The automotive OEM segment saw its revenue increase by 7.3% in the third quarter, reaching $830 million. This segment is doing well, outpacing the overall growth in the auto industry. The welding segment also showed good progress, with operating income increasing by 4.5% to $156 million in the third quarter. The polymers citrine amp fluids segment, however, experienced a slight revenue dip of 1.8%, bringing it to $441 million. While the operating income remained relatively stable, this revenue decline suggests some headwinds for this particular part of the business. Interestingly, the construction products segment, despite seeing a slight drop in revenue, managed to improve its operating margin significantly. It rose to 31.6%, an increase of 140 basis points. This suggests they are getting more efficient even with lower sales volumes, which is a positive sign of good management. When we look at the company's overall effectiveness in using its invested capital, the after-tax return on average invested capital was 29.8% for the 9 months ending the 30th of September 2025. This is a solid number, indicating they are generating good returns on the money invested in their businesses. It's slightly down from last year's 31.3%, which is something to keep an eye on, but still at a very healthy level. Let's talk about debt. The company's total debt to EBITDA ratio was 2.0 as of the 30th of September 2025. This ratio tells us how many years of earnings it would take to pay off all their debt. A ratio of 2.0 generally means they are in a good position to manage their debt. It is up from 1.7 at the end of 2024, which is a slight increase, but still within healthy limits. Now, ITW also includes a section on forward-looking statements. This is where they talk about what they expect to happen in the future. They mention potential impacts from global supply chain challenges, trade policies like tariffs, and economic conditions. It is their way of managing expectations and warning investors about potential risks. They are clearly aware of the uncertain global economic climate. So, what is my take on all of this? Illinois Tool Works Inc. is a company with incredibly resilient core businesses. Their ability to maintain stable revenues and generate significant cash flow, even in challenging times, is impressive. The strong operating margins in many segments, especially the improvement in construction products, show they are adept at cost management and operational efficiency. The 80/20 business model and customer-backed innovation seem to be truly working. However, there are a few things to consider. The increase in long-term debt, while still manageable, warrants attention. Also, the significant amount of cash being spent on share buybacks and dividends while rewarding shareholders does reduce the capital available for reinvestment and acquisitions. While the company's overall strategy seems sound, relying heavily on these distributions could limit future aggressive growth opportunities. The slight dip in year-to-date operating income and the overall revenue flatness for the year suggests that, while they are profitable, expanding at a significant pace might be a challenge in the current economic environment. Overall, ITW appears to be a well-managed company navigating current economic challenges effectively. Their diversification across 7 segments likely provides a strong buffer against downturns in any single market. The key will be their ability to reignite organic growth beyond the current steady state and manage their debt levels prudently as interest rates potentially fluctuate. Alright, that is our breakdown of Illinois Tool Works Inc.'s latest filing. What is your take on these numbers and what they signal for the company's future? Drop your thoughts in the comments. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out the Discord in the description. Thanks for watching, see you next time.